Hello, everyone, and welcome to Money Show's virtual event. Next up is Jay Mitzmeyer, the head of research for Value Investors Edge, who's going to tell us about maritime shipping and riding the global economic recovery. Then at the end, we're going to take a few questions. So if you want to type them in the box on the right side of the platform, we will address them at the end. So Jay, thanks for being here today, sir. You have the floor. Please take it away.
All right, thank you very much. Good afternoon, everyone. Welcome to this session of the Money Show Virtual Expo. We're going to talk about maritime shipping and why I believe that's one of the best places to be invested for a COVID-19 recovery play. First of all, I'm on Twitter at Mintzmeyer, if you want to follow me there for free trade updates or position updates, commentary on the shipping industry. We also have 2-week research free trials available at mintzmeyer.com, and we'll bring this slide up again towards the end if you want to write that down. So I've been here before on the Money Show webinars. Kudos to them for setting these virtual events up so we can still share investment ideas and trades even with the COVID-19 pandemic. So these recordings are available on my YouTube channel under Jay Mintzmeyer. I think Money Show also has a YouTube channel. And I was here last August and again in December talking about a similar trade, talking about the maritime shipping industry and why it was a good idea to start looking into these stocks for potential recoveries. So back in August, I gave a presentation similar to today's, talking about the outsized return potential of maritime shipping. So we gave 5 top picks in that presentation, and they've returned 91% in the last 8 months. So just a little teaser there to pay attention to some of the picks we're going to drop today. And I can't promise a repeat of those results, but just some evidence of what we've done before. All 5 of those were positive, median return of about 59%, and that outperformed the S&P 500 there for about 67% in 8 months. So that's the kind of outperformance that you're happy about over several years, and that was over 8 months. Then again, in December, we came back and we talked about the COVID recovery potential. We had 5 picks there. They were up 39% in 4 months. Again, 5 for 5. Better to be lucky than good is what I always say. But we were certainly lucky, and we outperformed the S&P 500 by 28% in those 4 months. So just a little teaser to pay attention today. We're going to have 4 top picks from the industry. So today what we're going to talk about is I'm going to share my team's overall background and our approach to the shipping markets. We're going to talk about the COVID-19 impact to the shipping sector and the stock specifically. Then we're going to talk about the recovery progress, what we've seen so far year to date. Are investors coming back? What are traders doing? And then kind of the meat of the presentation are 4 key areas to play this global recovery. We'll talk about container ships, dry bulk, tankers, and the LNG segment. And then finally, we'll share our top overall pick and get into some Q&A, hopefully about 5-10 minutes at the end. So if you have any questions as this goes along, feel free to type those into the chat. We'll try to get to them at the end. So how do we profit and outperform in this segment? Shipping's a very challenging area. So what we do is we stick to our lane. We don't look at things that are way outside like Apple or Tesla, where there's all sorts of big institutions involved. We stick with these small cap names with not a lot of institutional coverage. I focus exclusively on maritime shipping and trade infrastructure. My James Catlin focuses on macro and commodities. We have Michael Boyd, who focuses on energy and income. Clement Mullins, who joined us more recently, focuses exclusively on maritime shipping. So very top tier professionals that stay exactly inside our lane. What you can see is since 2016, again, not a formal pitch for an investment, anything like that. These are unaudited results. But as you can see, sticking in our lane has been very profitable over the last 5 years. We started the service in 2016 was our first full year. You can see on the left, we've had very strong returns while focusing on a very challenging industry. If you look on the far right there over here, you can see the shipping industry's had a lot of ups and downs over the last 6 years. Here's the Russell 2000 comp in the middle. You can see that Value Investors Edge has outperformed significantly. Of course, past performance, not a guarantee of future results. And this isn't an investment product or anything like that. We just have research and we have model portfolios, but just an example. And I think this applies to all industries. If you stay in your lane and focus at what you're good at, you're going to do a lot better than if you're just a generalist. So let's move on a little bit and talk about the COVID-19 impact to shipping stocks specifically. So COVID-19 was rough in 2020. Every single shipping stock, no matter what you did, no matter what segment you were in, crashed during the first half of last year. There was, even more surprisingly, there was no gains from April to August. Everything stayed down. And the weird part is that a lot of the shipping earnings were actually quite strong. The earnings, the free cash flows were resilient, but it didn't matter. The stocks traded down because the overall story and the common person's understanding were that shipping stocks were a bad place to be. Last August, when I was here, only 2 out of the 55 names we follow were positive. When I came back in December, only 4 out of those 55 were positive year to date. That means 93% of the industry last year was a loser. So that's a pretty stark reminder of how bad things were last year. Shipping equities hit record low valuations last year in 2020. And the odd part is that the broad market was at record highs. So you had the broad market at record highs, shipping stocks at record lows, probably the biggest dislocation I've seen in my life. And we might never see something like that again. So here it is in graphical form. You can see the first quarter was rough for everybody. Shipping down the most on that blue line, about 50% down. April to August, shipping is flat. You don't get any gains last summer from any sort of shipping stocks on average. You can see the NASDAQ recovered pretty nicely back into positive territory. Russell recovered a lot. And then into December, shipping took the lead on a relative basis for those couple months, but pretty meager. I mean, 18% returns, but you're already down 50%. So you can see this blue line here. Shipping still had a lot of losses for the year heading into December. So that set us up pretty nicely to invest in some of these recovery plays. So why did this happen? Why did these stocks lag? Well, first of all, it was kind of an everyman's perception that shipping was doing poorly, but also as more quantitative and retail money came into the market, it was a very bad sector and style screen for folks. First of all, you had value. People hated value last year. You had small cap stocks, even worse. International focus, commodity stocks, a huge leverage, especially relative to some of their peers. And you had that China exposure. It was like the basket of everything that nobody wanted all thrown together. And that was the shipping stock in general. If you didn't actually dig below and see what the earnings, see what the free cash flow was, if you just looked at the stock by itself, that's what you saw, and it was ugly. Also, a lot of shipping investors, at least the folks I work with, are deep value oriented. They're the kind of folks who take out their notepads and figure out what the earnings are going to be, what next year's demand and supply look like. A lot of the deep value folks, myself included, were very skeptical about last year's market. A lot of the folks pulled a lot of their money out of the market, stayed on the sidelines. So not only did shipping screen bad, a lot of the natural buyers just were nowhere to be seen. And then finally, the 2010s were a very brutal decade for shipping. So you had a lot of people with bad experiences in the sector, a lot of recency bias, a lot of people that had sworn off the sector. So you add all three of these things together and you have that recipe. So importantly, why is this changing now? And it started in December, but we're in the middle of kind of a turnaround right now. So why is this changing? Well, first of all, the value investors are coming back. They've realized they need to get back into the markets, and they're looking at these shipping stocks and they're seeing a very strong value proposition. First, we had that record low pricing in December. And secondly, the forward supply and demand setup is very optimistic. Next, these firms, many of them, are earning record cash flows. And on top of that, the balance sheets are the strongest they've been in decades. So once COVID-19 is behind us and the companies feel a little bit more stable, we can expect to see large dividends and repurchases pretty much across the board. And we've already seen these repurchase programs at several companies. I've listed a few there. The last one on the list, Dorian LPG, they've repurchased about 25% of their stock in the last 2 years. It's just a remarkable disconnect in some of these names. And then finally, I'm not a huge inflation trader myself, but if that's kind of something you're thinking about, you're thinking about gold or silver or crypto, Bitcoin, some sort of inflation hedge, then consider shipping is probably the best inflation hedge on the market. Not only are you buying steel-built vessels, which are a commodity in themselves, you're buying something that has tangible value and has a lot of fixed debt associated with it. If you think about what happens in an inflationary environment, your asset values go up and the fixed cost of your debt, like the real value of that, goes down. So you think about the leverage impacts to both net asset value and earnings per share. It's remarkable. Shipping's probably the best place to be in an inflationary environment. So this recovery is already kind of underway. It started mostly last December. And we'll look at the performance year-to-date 2021 real quick. So our model portfolio in 2021 is up about 80% year-to-date. That was as of last night. And our risk reward model is up about 40%. It's a little bit safer, a little bit more secure stocks. And you can see the chart here. And so this model shows you kind of the gains over the year. And this purple line here is the average shipping index. This is the average shipping stock on the market. You can see the first 5 or 6 weeks, we kind of tracked that index. But as we got further into the year and volatility came back to the market, the lower quality, junkier shipping kind of penny stock names started to fall apart. And you see that our picks here are kind of outperformed. And that's what we're in the business of. We're in the business of picking a niche industry, finding the best stocks and the best opportunities. So someone might say, yeah, you got lucky, you picked a good industry to be in. Well, this year we did. The shipping index is well above the Russell, but you can see both of our models are, even the risk reward, which is a lot safer names, is significantly above the shipping index. So, enough on that. Let's kind of pivot a little bit and talk about the key themes here. So we're going to bring up 4 segments: container ships, dry bulk, tankers, and LNG. We're going to walk through the fundamentals of each a little bit, and we'll share a top pick in each segment. Starting off with container ships. This is the biggest long-term bull run right now is in container ships, focused on restocking and a little bit of supply disruption as well. We have this issue in both the European Union and the United States where store shelves are empty, and there's a big need for restocking because of high consumer demand. Well, at the same time, the container ship sector was underinvested for about 5 years. The returns were really bad, so nobody was building enough of these ships. Well, because of that dislocation between supply and demand, the rates have surged, and they're sitting around 15-year record highs right now. The new supply into the market is pretty limited. We have about a 15% total order book now, but most of these orders arrive in 2023 and 24. So we have about 3 years of solid potential rates here before that supply hits the water. So we're really bullish about the next couple of years there. Additionally, there's little disruptions like the Suez Canal blockage. I had more inquiry last week, about a week and a half ago, over the Suez Canal than I had most of this entire year. And it's funny because, rates were already at 14 or 15-year highs, and everyone, calling me or tweeting me and asking me, what's this impact going to do? And, it's kind of like watching like a baseball game or like the World Series, and you're up like 10-0 and some guy hits a home run and everyone's like, oh my God, a home run. It's like, dude, have you not been watching the game? I mean, we're up 95%, and Suez Canal, that's just like a cherry on top of the sundae. So we're really enjoying this market, and it's not about little dislocations. It's a significant sea change in this market. So our top pick in containers by far is a stock called Zim Integrated Shipping. They're kind of a specialist container liner. Think about UPS and FedEx as the big logistics players, and think about how like DHL is a little bit smaller, a little bit more crafty. That's what Zim is. They're a very niche carrier that's benefiting a lot from these dislocations. Some of the other names are listed here as well. Keep in mind, I run a research service and I'm long many of these names myself. I actually have a long position in Zim. I have a long position in all the top picks I'm going to share today. So just keep that in mind. Nothing here today is investment advice or a recommendation of any form. I'm just sharing my research and letting you know some of the stocks that I personally like. So a quick review of the containership sector. It's an oligopoly market. 5 container liners control 65% of the world's tonnage. The top 10 control 85%. And if you think that's crazy, it gets even worse. The 2 major freight alliances control about 75% of the global tonnage. Can you imagine 2 players, 75%? I mean, it's unreal, it's unbelievable. So Zim was our top pick, and you can see them down here. They're about number 10 on the list. And you say, oh, well, they're 10. I don't know about picking a small player like that. But keep in mind, they're in an alliance with Maersk and MSC. The 2 biggest container ship players in the world are in an alliance with Zim, where Zim handles some of the smaller niche routes and MSC and Maersk handle the large benchmark routes. So it's a very beneficial position to be in, and Zim is reaping almost all the profits on those niche routes. Here's a 2-year chart. You can see the V-shaped COVID recovery that everybody talked about, only it looks like a beautiful check mark. And if you zoom out even further, this is a 20-year chart, you can see the enormous recovery we've had in the last few years. We're about 15-year highs now, but there is precedent in the mid-2000s for about a 3-year straight run of solid rates. And what happens to get a 2 or 3 year solid run of rates like that is your demand has to outpace your supply. Well, as I mentioned, the order book doesn't really start hitting until 23 and 24. So I believe we're in 2021. We're hopefully at the first year of this. I don't know if rates are going to keep going straight up. I don't think anybody should expect that to happen, but these levels are pretty healthy, and we're hoping they can hang out for a little bit longer. Keep in mind, this rate as well is a 1-year charter rate. And many charters now are getting signed for 2 or 3 years around these same levels. So this isn't like tankers or dry bulk where it's 60 days or 80 days. These are 1, 2, 3, sometimes even 4-year rates that are getting signed. So a company finds a vessel here and you're good till 2023 on these rates. So very, very, very phenomenal. So next up, we have dry bulk. And this is all about the infrastructure stimulus as well as some shifting trade flows around the world. The biggest size of dry bulk ship is known as a Cape size, at least the biggest indicator. And that's reliant heavily on iron ore flows. Brazil is developing some of the world's largest exports, and we expect to see those exports surging starting this year through about 2024. China is the major buyer, and China is starting to replace some of their iron ore from Australia with iron ore from Brazil. That iron ore from Brazil is almost 3 times further to transport. So even if the volumes are constant, the demand for that specific route can triple. So we're very bullish on that. Additionally, China and Australia are having some fallout around the COVID-19 circumstance. If you're into political science, you might have heard of the Quad. There's a lot of tensions between China and Australia, and we're seeing some diversion of coal trade as well, which is very bullish because China and Australia, right, very close in maritime speak, whereas now China has to buy their coal from other countries and Australia is selling it to other countries. So a very niche rerouting of trade that's helping us out. So our top pick in dry bulk is Navios Partners. And the cool thing about Navios Partners is they also have a lot of container ships. So you get everything I just talked about the last 5 minutes, and you get the dry bulk kind of bonus. Some other firms up there. So the dry bulk market is very seasonal. Usually February and March are kind of the worst 2 months of the year. And even though those are the worst 2 months of the year, as of late March and now early April, the rates are in the top 3 to 4% of the past decade. So that's remarkable. I mean, we're at the worst point of the year and the rates are at like nearly 5-year highs. So just imagine the potential, what those rates can do into the summer and into the fall as the world starts to normalize a little bit more. Here's a 5-year chart. This shows where we're at right here compared to the last 5 years. As you can see, we're very close to a 5-year high, even though we're at the worst part of the year. And throughout this chart, you can kind of see all those troughs. Almost all those troughs are February and March. That's kind of the worst part of the year. Next, we're talking about tankers. With tankers, we're looking mostly at the fleet profile and a recovery play. I mentioned earlier how shipping did really well during 2020 for the most part, and how COVID didn't really impact them that much. It was a bit of a misnomer. Tankers are the one segment that did get hit pretty hard by COVID-19. There was a big impact to jet fuel consumption, which went down a lot. Plus, OPEC was very strong with their cuts. That hurt the tanker market. There's no denying it. And rates are pretty weak right now. So with tankers, you really are betting fully on a global recovery. So unlike the other names that are generating strong free cash flow now, tankers are probably more of like a Q3, Q4 of 2021 type play. But, you know, as an investor, you want to buy the stock, you know, you want to start to buy it before the event happens. So that's what makes them kind of interesting as a play. So our top pick in tankers overall has a lot of fleet exposure to a bunch of different types of assets. Is International Seaways, stock symbol INSW, and some other firm holdings are down there as well. This chart here shows the average age of tankers. This is provided by Euronav. It's a few months outdated. It's actually even older now. But as you can see, according to this chart, the large tankers are the oldest they've been on average in 10 years. Now, if you include all the product tankers and some of the medium-sized tankers, we're pretty much near record highs of old tankers. That means that as these ships get older, they need to go through expensive surveys. They might need to be demolished. So we're seeing a lot of bullish indicators on the supply side. Here's kind of a forecast of the demand side. This is also by Euronav. You can see the peak here in 2019, that big slip into 2020, and they're forecasting, and this is a couple months old, but they're forecasting for 21 to be mostly recovered, maybe about 95 to 99%. It's going to take until 2022 probably to set new highs, but the market should be pretty strong by the back half of the year. Lastly, we'll talk about LNG. And LNG is interesting because it's a secular growth. It's a long-term growth story. I mean, we're not just talking 2 years. Like containers, we're saying 2 3 years. Dry bulk, we're saying it's a year or two, but the summer is going to be really hot. You know, tankers, we're saying it's going to recover probably next fall, this winter. LNG is like a 5 or 10 year type story. It's really a long-term investment. There was a lot of optimism in the sector back in 2018 and 2019, but unfortunately we had 2 super warm winters. And I say unfortunately for shipping. I'm sure the Asian folks were happy the winters were warmer, but as far as gas demand, it's obviously going to be lower when you don't need as much gas. COVID-19 also provided a big negative impact, but we saw this last winter, it was a very strong market. But it's seasonal, so it's only 2 or 3 months. So we're not quite there yet where we have that long-term sustainable rates, strong rates. We're not quite there. We're getting close. The LNG shipping markets, they're poised to grow about 10 to 15% per year for the next 5 to 10 years. I say 5 to 10 because we don't exactly know what the environmental regulations are going to look like yet. But right now it looks 5 to 10 years of solid growth ahead of us. The LNG pricing was super weak during 2020 because of COVID, but we've already bounced back. In fact, the LNG prices today are just as strong, if not stronger, than they were in 2019. This market is fully recovered. If you're waiting for a recovery play, I mean, we're on it. We've already recovered. And the last part is there's been significant engine technology changes over the last 5 to 10 years. There's 3 types of ships. I say technology bifurcation. I should probably say trifurcation because there's really 3 different kind of asset classes. We want to invest in the company that has the most modern tonnage and can outperform all of their peers. And that top pick is Flex LNG, stock symbol FLNG. That company owns 13 ultra modern vessels. They're all built in the last 2 to 3 years, and they can outperform their peers by $15,000 to $20,000 per day. Some other firms to consider, we have Gaslog, Golar, and TK. So big picture macro in the LNG trade, it's all about US exports. That's what it comes down to. And the United States started exporting in 2016. They are the largest source of future export growth over the next decade. And the United States is probably going to be the second largest global exporter by probably 24, 25, 26, somewhere in there. There was temporary COVID-19 delays on export infrastructure. The market got dislocated for a little bit, but we're already back on track, as this next slide shows. EIA data shows that we had kind of the V-shaped recovery. And as of about last October, November, we are 100% recovered, and we are clearly back on this massive growth trajectory for the United States. So expect that to continue almost a straight line up through like 25, 26. Here's the seasonality I talked about. This makes dry bulk look even less seasonal. This is the most seasonal market you can get. You can see every single winter you have these peaks, and the higher the peak kind of points to like the stronger the market, like how much balanced that market is. And then kind of the width of the peak is how cold the winter was. So you can see kind of like if the colder winters give you kind of a wider peak and so on. So we're pretty balanced. It's a pretty healthy market. We're just not quite seeing enough follow through into the spring. Rates dip down here, but that's seasonal. We expect them to climb back up into the summer and next fall. So again, a review of the overall top picks. Go ahead and jot these down. Keep me accountable. Send me, either throw some candy at me or some rotten tomatoes in a few months, depending on how these do. But the first one, Containerships, we definitely like Zim Integrated, ZIM. Dry bulk, we like Navios Partners, NMM. Tankers, International Seaways, INSW. And LNG, we like Flex LNG, stock symbol FLNG. And then the top overall selection by far of these 4 names is Navios Maritime Partners. So it's a quick rundown of what they offer. So we expect their earnings for 2021 to be somewhere between $10 and $12 per unit. For 2022 and 23, we expect between $10 and $15 of earnings per unit. And I know that's a kind of a wide range, but right, we're in April of 21 talking about 22 and 23, but we can start to forecast that with more and more confidence because half of their fleet is container ships, and a lot of those container ships are already getting bookings into 22 and into 23. In fact, they have several container ships that go towards the middle of the decade. So we can start to get more and more confident as we move along. But that's sort of the earnings I'm expecting from that company. For the net asset value, it's about $55 a unit right now. And we expect that net asset value to be closer to 70 by the middle to the end of the year. So 55 to 70 on the net asset value. And then our fair value, which honestly looks pretty ridiculously low considering the earnings and the net asset value, but our fair value estimate right now is $40 a unit. It's about 48% implied upside. We're keeping that low on purpose just to be conservative and cautious. There's been a little bit of issues with the management and governance of this company. So we're leaving some caution, we're leaving some headroom in there. But as you can see, the earnings are 10 to 12 probably this year, 10 to 15 next year, looking at net asset value of 55 to 70. I mean, this is the definition of deep value. So very bullish on this name. So with that said, here's kind of the contact info again, Twitter @Mintzmeyer. If you're interested in a 2-week research free trial, we have our Q1 earnings commentary, which just kicked off yesterday. And you can also get our model portfolios and our previous research. With that, I think we have about 5 to 10 minutes for Q&A. So I'll turn it over to our Money Show host.
Hey, Jay, Greg here. Thank you. Very interesting lane you have here. It's very unique and very exciting opportunities. By the way, before we get into the questions, so do these picks today, do they fall into your risk and reward safer choices, or are they part of your speculative group?
That's an excellent question. In fact, it depends on the company. So I'll jump back and we'll just walk through them really fast. So on Zim Integrated, it falls into both because it has both speculative upside and a lot of good risk reward balance. A lot of their contracts have already been signed. Navios Partners, I mentioned there's a little bit of governance there. So we have that in the speculative bucket, a little bit riskier. International Seaways also in the speculative bucket because it's depending upon that recovery play, right? We're waiting for those tankers to get better. And then Flex LNG also speculative because it depends on the spot rates. So of the safest name here is probably Zim Integrated, and then the next three are speculative.
Thank you. Thank you. Okay, let's jump into the question. So Angel wanted to know, says, the problem I have with shipping is it takes an active mindset and tons of research to manage. Losses over the long term, but huge profits over the short term. How can an ordinary investor benefit?
Yeah, that's a great question from Angel, and that's why we love this sector because it takes a lot of focus to outperform and do well here. So when you have a team assembled like ours, we have 4 folks kind of diving into this thing full time. We're able to exploit a little bit more of this. If you're someone who can't necessarily afford a research package or something like that, I would encourage you to pick maybe 4 or 5 companies that you have interest in and that you like the long-term story of, and then kind of dive in and figure out the financials, figure out the balance sheet, do a little bit of research on the supply and demand, and figure out what your fundamentals are. Invest in those companies if you want to. I can't give you investment advice, but if you like them, buy them. And then if the thesis change, don't let pride get in the way, right? If the thesis changes and the market goes away from you, sometimes you have to let these go. And that's what I see folks make the biggest mistakes on, is they get too prideful. They pick something, they really like it, and they don't want to let it go. Be nimble and do those fundamental research, and I think you'll be okay.
Very good. One of the questions came in earlier from Kimberly, says, huge follower of Jay Mitzmeyer since grad school. Have never covered marine before. So general question is, what are some of the industry indicators you'd recommend other than charter rates and order book, et cetera?
Again, a great question. So from the supply side, it's all about the order book. So it sounds like Kimberly's already over that one. If you understand the order book and the dynamics there, you got half the market. And it's the more predictable half. So good job on there. For demand, you have to look at the ton volumes of supplies and where you think they're going to be coming from. So for example, on dry bulk, I mentioned you have to understand the shifting trade flows between coal and iron ore and how that's going to play out. And that's why we have James Catlin on our team. He does all that stuff full time. It's not even enough for me to have time to do all that. I mean, it takes a whole team to look into this stuff. For container ships, the biggest correlate to container ship growth is GDP growth. And that's another reason why we're pretty bullish about 2021 and 22 on container ships. Each one of these sectors has their correlates. For oil, I would say overall global consumption and levels of exports by OPEC historically. We think it's going to change going forward, but historically, OPEC exports have been probably the biggest driver of rates. So that's 3 segments. Hopefully, it's a little bit helpful for you.
Very good. Go Bananas always has some good questions. Says, did Zim halt trading in 2014 and then resume in 2021? That's what the monthly chart reads.
Yeah, so Zim Integrated back in the 2008, 2009, 2010 cycle, they had a lot of hangover from the global financial crisis, and they had to go into restructuring mode. So their stock was basically delisted. They got restructured. A lot of their creditors and customers invested into that company. It was privately held that entire time. And they just IPO'd a couple months ago. In fact, they just IPO'd, I think, the end of January.
Gotcha. We just had one come in on Zim as well. Stephen wants to know, what's your expectations for Zim's Q1 earnings per share?
Oh man, put me on the spot there. I was really hoping, it's a good question. Zim reported their Q4 earnings in the middle of March. And I'm thinking, you only got 2 weeks left until Q1. Give us some good guidance, guys. And they didn't do it for us. And to be honest with you, they've only had 1 full quarter of public results. So it's hard to model these things. My range is very, very wide on Q1. I would say somewhere between probably about $4 and probably about $5.25. I know it's a little wide range, but that's what I'm looking at in earnings.
Thanks, Jay. Rick says, what about the effect of rising interest rates on the sector?
Yeah, so the interest rates, it depends. Nobody wants to see hyperinflation. If we see some of the 1970s hyperinflation, I'd be lying if I said that was great for us. But a slow and steady return to some sort of global inflation, I'm very bullish on that. I think you'll see the asset values of the ships, along with all other commodities, start to increase. And a lot of these companies, the better ones, have either fixed debt or they've swapped their debt to cap their interest rate expense. So if we see inflation start to take away, and I'm talking, 2, 3, 4, 5%, I'm not talking anything crazy, but 3 to 5% inflation, you're going to see those asset values increase. You're going to see the real value of the debt decrease, and that leverage effect is going to just be rocket fuel to the net asset value and earnings potential.
Okay, we've got room for one question, but I'm going to combine two. Douglas says, do you like the companies that are heavy into scrubbers like STNG and ASC? And what are their NAVs? And then also, Go Banana says, what can you say about the impact of cleaner fuel requirements for shipping? So I'm kind of throwing you.
Okay. Well, those are a lot of, those are a lot of questions. So I don't know if we have time to answer all of them, but as we go more and more into regulatory environments, whether it's greenhouse gases, whether it was the sulfur emission caps in 2020, that's going to benefit the modern tonnage more and more and more. And I mentioned with LNG, I like the fleet with the most modern tonnage. I like flex LNG in that segment. When it comes to tankers, I like the modern tonnage better on average, but I want to see what I'm paying for. If I'm paying 100% or 110% NAV for something with modern tonnage, and I can get a medium age for 60 or 70% NAV, I might make that trade-off. So I hate to just throw you like an it depends curveball, but it depends. You got to show me the valuations of these 2 or 3 or 4 different companies you're comparing against.
Really useful perspectives there, Jay. Thank you so much for taking those two at the same time.